Let's bring another voice into the conversation this morning. Joining us is Richard Fisher, former Dallas Fed president, of course, a CNBC contributor. Richard, great to have you. To Sarah's point about what we might hear today, if he does try to tee up anything dovish, do lawmakers then go after him on how dare you consider cutting before an election?
Well, I would expect there will be some political questions that are going to be asked during the Q&A period. And he's just going to hold firm. What he said in Sintra, and Sarah, you were there, that's Portugal. I know him well enough to know that's what he truly believes. Remember, his term expires in April 2026 or so. There's no way a president can impeach him. They tried that with Paul Volcker under Reagan. He outmaneuvered Reagan, who was a very powerful president, unlike the current president, on Capitol Hill. And I think he's totally indifferent. But Sarah, you touched on the key point, and I'm going to watch Janet Yellen's testimony in particular here. The cost of carry for the government debt that's rolling over right now in the 5% to high 4% range thus far has been 2%. Another third of our debt rolls over next year, and another third the year after that. Right. That's where the pressure comes at the longer end of the yield curve. So Powell's very adroit and properly adroit in avoiding that question. I don't have to worry about it anymore. I'm no longer on the FOMC. But that, to me, is the key issue that's going to drive rates from the belly of the curve out. Short term, think about the numbers. A 2% carry is being refinanced now by a 5% carry if it's 1 year or less, or the high twos if it's closer to 1 year. So we have a real problem in financing our fiscal policy, and it's going to be interesting to see, since neither Trump nor Biden have talked about how to reduce that burden, how to deal with it, how the market begins to price that kind of debt, and how it affects spreads above that debt. Right now, triple Cs are paying 13.25. The NFIB numbers you just cited, those smaller businesses are paying 9.5. So we'll have to see what kind of impact that has. And to me, it's dependent on fiscal policy.
Agree, Richard, but there's plenty of demand for U.S. debt. Everybody's sounding
right.
The alarm, but
yes,
can't get enough
Sarah,
of it.
Sarah, you're absolutely right. It's not just for U.S. debt. I just came back from 2 weeks in Europe and the U.K. in London. I met with CEOs on behalf of Jefferies, who I advised, and some of the biggest bankers, CEOs. All of them are worried about what's going on in Europe. To a person, they all voiced an interest in investing real capital in plant and equipment in the United States. And by the way, to my delight, they mentioned just a handful of states they're interested in: Texas, Tennessee, Georgia, North Carolina. That's pretty much it. So they look at what's going on here. They are worried about the tariffs that both Trump and Biden seem to be cottoning to, particularly Trump with a 10% across the board. They realize that we are the center, the United States, of innovation and creativity and enterprise. And they all think, whether it's Spain or France or the UK or wherever, they all think that Europe is in decline. It's been growing subliminally for the longest time. Their outlook is even worse. And on the pure money front, we offer a great nominal yield, 5% at the short end, 4% plus further out the curve. That's hard to resist, particularly after the ECB cut rates. The Canadians made a cut, the British made a cut, and here we are, the United States of America, the most promising place on the planet for big capital to go to. Of course we're attractive, and I think that's holding yields down. The question is, how long does that last?